If you've ever wondered what would happen if you stopped overthinking your investment strategy and just picked two simple funds, this video is going to show you exactly that. In April of 2023, I took $50,000 in cash that had been sitting in a savings account earning almost nothing, and I split it between just two Vanguard index funds. No complicated strategy, no constant trading, no trying to time the market. Just two funds, one deposit, and then I waited. 18 months later, the results taught me more about real investing than years of research ever could. And if you want to see more real money experiments like this, hit that subscribe button right now because we're just getting started. Before I show you the exact numbers, the gains, the losses, the surprises, and what I'd do differently, we need to talk about why this experiment even matters. Because the investment industry has spent decades convincing people that successful investing requires complexity. They want you to believe you need dozens of funds, active managers, constant rebalancing, and a PhD in finance just to have a shot at decent returns. But the reality is far simpler and far more powerful. The best investors in the world, the ones managing billions of dollars, consistently point to the same truth. Simplicity wins over time. Warren Buffett has said repeatedly that a simple, low-cost index fund will outperform most professional investors over the long run. Jack Bogle, the founder of Vanguard, built an entire investment philosophy around this idea. Buy the whole market, keep costs low, and let time do the heavy lifting. That philosophy is exactly what I wanted to test with real money and real market conditions. So, in April of 2023, I made the decision. $50,000 split evenly between two Vanguard funds. The first fund was VTSX, the Vanguard Total Stock Market Index Fund. This fund is as simple as it gets. It owns a little piece of nearly every publicly traded company in the United States. When you buy VTSX, you're buying small-cap companies, mid-cap companies, and large-cap companies all at once. You own tech giants, industrial leaders, healthcare innovators, financial institutions, consumer brands, and everything in between. The fund holds over 3,600 individual stocks, which means you get instant diversification without having to pick winners or avoid losers. If the U.S. economy grows over time, this fund captures that growth. The expense ratio is incredibly low at just 0.04%, which means for every $10,000 invested, you pay only $4 per year in fees. Compare that to actively managed funds that can charge 1% or more, and the difference compounds dramatically over decades. VTSX yielded about 1.3% in dividends when I bought it, and it had a long track record of steady growth through multiple market cycles. It wasn't flashy, it wasn't exciting, but it was exactly the kind of foundation every portfolio needs. The second fund was VTIX, the Vanguard Total International Stock Index Fund. This one does for the rest of the world what VTSX does for the United States. It invests in companies across Europe, Asia, emerging markets, and developed markets outside the U.S. It holds over 7,900 stocks from more than 40 countries, giving you exposure to some of the largest and fastest-growing economies on the planet. The expense ratio is also low at 0.11%, still far cheaper than most active funds. VTIX yielded around 2.8% in dividends at the time I invested, noticeably higher than VTSX, which added a little extra income to the overall portfolio. The reason I included international exposure is simple. The U.S. stock market has been incredibly strong for a long time, but that doesn't mean it will always lead. There have been entire decades where international markets outperformed U.S. markets, and there will be decades like that again. By holding both, I wasn't making a bet on which region would win. I was making sure I didn't miss out no matter which one did. So, the allocation was straightforward. $25,000 into VTSX and $25,000 into VTIX. One deposit, no timing strategy, no plans to sell, and no intention to check the account every single day. The goal was to let the market do what it does, ride out the ups and downs, and see what 18 months of real-world investing would look like. And the timing of this experiment turned out to be more interesting than I expected. April of 2023 wasn't a calm, predictable moment in the market. It came right after a brutal 2022, a year when both stocks and bonds dropped together, something that hadn't happened in decades. Inflation had spiked to levels not seen since the 1980s, and the Federal Reserve was aggressively raising interest rates to try and cool things down. By the time I made the investment, the S&P 500 had recovered some of its losses, but uncertainty was still everywhere. Headlines were filled with recession warnings, concerns about banking stability, and debates about whether the market rally was real or just a temporary bounce. It wasn't the perfect time to invest, but here's the thing. There's never a perfect time. If I had waited for certainty, I'd still be waiting. The decision to invest in April of 2023 wasn't based on predicting what would happen next. It was based on accepting that I couldn't predict it and investing anyway. And that mindset, more than anything else, shaped the entire experience. The first month after investing was surprisingly boring. The portfolio barely moved. VT-SAX went up a little, VTIX stayed flat, and the overall balance hovered right around the $50,000 mark. I checked the account maybe twice that first month, and each time there was nothing dramatic to report. But by June of 2023, things started to shift. The U.S. market began to pick up momentum, driven largely by big tech stocks recovering from their 2022 lows. Companies like Apple, Microsoft, Nvidia, and Amazon were climbing fast. And because VT-SAX holds all of these companies, the fund moved with them. Within 2 months, VT-SAX was up about 6%, adding roughly $2,500 to that portion of the portfolio. VTIX, on the other hand, wasn't moving nearly as fast. International markets were recovering more slowly, weighed down by weaker economic growth in Europe and ongoing concerns in China. By the end of June, VTIAX was up only about 2%, adding around $500. The total portfolio sat at about $52,000, a gain of $2,000 in just over 2 months. It felt good, but I also knew that early gains don't mean much. Markets can reverse quickly, and 2 months of data doesn't tell you anything about long-term success. So, I kept the same approach. No changes, no trades, just let it ride. July and August brought more of the same. VT-SAX continued climbing as the U.S. market stayed strong. By the end of August, that fund was up nearly 10% from my original investment, turning the $25,000 into about $2,750. VTIX was still lagging, up only around 4%, bringing that portion to about $26,000. The total portfolio now sat at roughly $3,500, a gain of $3,500 in 5 months. On paper, that's a 7% return in less than half a year, which annualized would be well over 10%. But I also knew that short-term returns don't predict long-term outcomes. The market was riding high on optimism about inflation cooling and hopes that the Federal Reserve might pause rate hikes. That optimism could disappear just as quickly as it arrived. And sure enough, September brought a reminder of how fast things can change. The market pulled back sharply in September of 2023. Concerns about higher interest rates lasting longer than expected started to weigh on investor sentiment. The S&P 500 dropped about 5% that month, and VT-SAX dropped right along with it. Suddenly, the $27,500 in VT-SAX fell back to around $26,000. VTIX also dropped, falling to about $25,500. In 1 month, the portfolio gave back nearly $2,000, dropping from $53,500 down to about $51,500. That pullback was the first real test of the strategy. It's easy to stay calm when everything is going up. It's much harder when you watch thousands of dollars disappear in a matter of weeks. But this is where the simplicity of the approach really mattered. Because I wasn't trying to time the market, I had no reason to panic. The plan was always to hold for the long term, and 1 bad month doesn't change that. I didn't sell, I didn't adjust the allocation, I didn't do anything. And that decision to do nothing turned out to be one of the most important moves of the entire experiment. By October, The market started to stabilize. The losses from September stopped getting worse, and both funds started to recover. VTSX climbed back to around $27,000, and VTIX moved back up to about $26,000. The total portfolio was back to roughly $53,000, erasing most of the September drop. But the real momentum came in November and December of 2023. Those 2 months were some of the strongest the market had seen in years. Inflation data started to come in better than expected, and the Federal Reserve signaled that rate hikes might be done. Investors responded with heavy buying, and both U.S. and international markets surged. By the end of December, VTSX had climbed to about $20,500, a gain of nearly 18% from the original $25,000 investment. VTIX also rallied, reaching about $27,500, up roughly 10% from the start. The total portfolio closed out 2023 at approximately $57,000. That's a gain of $7,000 in just 8 months, a return of 14%. For context, the historical average annual return of the stock market is around 10%. This portfolio had already exceeded that in less than a full year. But again, I knew better than to assume that pace would continue. Markets don't move in straight lines, and a strong finish to the year doesn't guarantee a strong start to the next. And January of 2024 proved that point immediately. The new year started with optimism, but it didn't last long. By the end of January, both funds had pulled back slightly. VTSAX dropped to around $28,800, and VTIX fell to about $27,000. The portfolio dipped to roughly $55,800, giving back about $1,200 from the December peak. It wasn't a major drop, but it was a reminder that volatility never really goes away. February brought more of the same choppy action. Some days the portfolio was up, some days it was down, but by the end of the month it was roughly flat compared to January. VTSX hovered around $20,500, and VTIX stayed near $27,000. The total sat at about $55,500. The excitement of the late 2023 rally was gone, replaced by a market that seemed stuck in place. But then March arrived, and everything shifted again. March of 2024 turned out to be another strong month. Optimism around corporate earnings and hopes for Federal Reserve rate cuts in the second half of the year pushed markets higher. VTSX jumped to around $30,000 and VTIAX climbed to about $28,000. The portfolio reached $58,000, a new high and a gain of $8,000 from the original investment. That's a 16% return in less than a year. And the momentum didn't stop there. April, May, and June of 2024 all brought steady gains. The U.S. market continued to lead, driven by strength in technology and communication services. VTSAX kept climbing, reaching about $31,000 by the end of June. VTIX also moved higher, though at a slower pace, reaching around $28,500. By the end of June 2024, the portfolio sat at approximately $59,500. That's a gain of $9,500 from the original $50,000, a return of 19% in just 14 months. At this point, the power of simplicity was becoming undeniable. I hadn't made a single trade. I hadn't tried to time a single dip or rally. I hadn't moved money in or out based on headlines or predictions. I just held 2 funds and let the market do what it does. And the result was a return that beat the majority of actively managed funds, beat most day traders, and required almost no effort. But the experiment wasn't over yet. July and August brought more volatility. The market started to worry again about inflation staying stubborn and the possibility that rate cuts might not come as soon as expected. VTSAX pulled back to around $3,500, and VTX dropped to about $28,000. The portfolio fell to roughly $58,500, giving back about $1,000 from the June peak. It wasn't a major loss, but it was another reminder that markets move in waves. The key is to stay invested through all of them, not just the ones that feel good. And then came September of 2024, which turned out to be a turning point. The Federal Reserve finally cut interest rates for the first time in years, signaling confidence that inflation was under control. Markets responded with a strong rally, VTSX surged to around $32,000 and VTIX jumped to about $29,000. By the end of September, the portfolio reached $61,000, a new all-time high and a gain of $11,000 from the start. That's a 22% return in 17 months, more than double the long-term average annual return in less than a year and a half. And it all came from doing nothing but holding two simple index funds. The final month of the experiment, October of 2024, brought the portfolio to its 18-month mark. And this is where the final numbers came in. By the end of October 2024, VTSX had grown to approximately $30,500, a gain of about 30% from the original $25,000 investment. VTIX had grown to about $29,200, a gain of roughly 17% from the original $25,000. The total portfolio value was approximately $61,700. Starting from $50,000, that's a gain of $11,700 in 18 months. That represents a total return of 23.4%. To put that in perspective, if you had left that $50,000 in a typical high-yield savings account earning 4% per year, you would have made about $3,000 in 18 months. This portfolio made nearly 4 times that amount. And it didn't require any special skills, any insider knowledge, or any complicated strategies. It required 2 things, a simple plan and the discipline to stick with it. But the numbers only tell part of the story. The real lessons from this experiment go far deeper than just percentages and dollar amounts. The first lesson is that simplicity actually works. We live in a world that constantly tries to convince us that more is better. More funds, more trades, more strategies, more complexity. But this experiment proved the opposite. 2 funds, 1 decision, and 18 months of doing nothing beat the vast majority of active approaches. The second lesson is that volatility is not the enemy. During those 18 months, the portfolio dropped multiple times. September 2023, January 2024, and August 2024 all brought pullbacks that wiped out thousands of dollars in gains. In the moment, those drops felt uncomfortable. But looking back, they were just noise. The overall trend was up, and the only way to capture that trend was to stay invested through the dips. Trying to avoid volatility by jumping in and out of the market would have killed the returns. The third lesson is that international diversification matters, even when it lags. VTIX underperformed VTSX during this period, and there were moments when I questioned whether it was worth holding. But diversification isn't about chasing the best performer. It's about making sure you're positioned for whatever happens next. The U.S. market won't lead forever, and when international markets eventually take the lead, VTIX will be there to capture it. The fourth lesson is that time in the market beats timing the market every single time. I invested in April of 2023, which wasn't a perfect moment. The market had already recovered some from its 2022 lows, and there were plenty of people saying it was too late to buy. If I had waited for a better entry point, I might still be waiting, and I would have missed an $11,000 gain. The fifth lesson is that dividends add up quietly in the background. During those 18 months, both VTSX and VTIX paid dividends every quarter. I reinvested every single dividend automatically, which meant those payouts bought more shares, which then generated more dividends. By the end of the experiment, dividends had contributed over $1,800 to the total gains. That's money I didn't have to work for, money that just showed up because I owned the funds. And the sixth lesson, maybe the most important one, is that investing doesn't have to be stressful. Once I made the initial decision and set up automatic dividend reinvestment, there was almost nothing to do. I checked the account maybe once a month, sometimes less. I didn't watch CNBC. I didn't obsess over daily market moves. I didn't lose sleep over headlines. The simplicity of the strategy removed the stress, and removing the stress made it easy to stick with the plan. That consistency is what turned $50,000 into $61,700. Now let's talk about what I'd do differently if I were starting this experiment today. First, I'd add regular contributions on top of the initial lump sum. This experiment started with a one-time $50,000 deposit. But in the real world, most people invest over time. Adding even $500 or $1,000 per month would have dramatically increased the final balance and smoothed out the impact of market volatility through dollar-cost averaging. Second, I'd probably adjust the allocation slightly. The 50-50 split between U.S. and international was simple, but a 60-40 or 70-30 split favoring the U.S. might better reflect the fact that U.S. markets have been stronger and more consistent over the past decade. That said, I'd still keep meaningful international exposure because diversification has value even when it doesn't feel like it. Third, I'd consider adding a small bond allocation for stability. This experiment was 100% stocks, which worked well because the market trended up. But if we had hit a deeper recession or a longer bear market, having 10 or 20% in bonds would have cushioned the blow and made it easier to stay calm. And fourth, I'd document the journey more actively. This experiment was mostly private. I didn't share updates in real time, and I didn't track my emotions through the ups and downs. If I did it again, I'd keep a journal or make regular videos to capture what it actually feels like to invest real money through real volatility. That kind of documentation would make the lessons even clearer. But even with those adjustments, the core strategy would stay the same. 2 funds, low costs, automatic reinvestment, and a long-term mindset. Because this experiment proved that you don't need complexity to build wealth. You just need a plan that works and the discipline to stick with it. So, what happens next? As of now, that $61,700 is still invested in the same 2 funds, and I have no plans to sell. The 18-month experiment is over, but the investment continues. Over the next 5 years, that portfolio could grow to over $100,000 if it continues earning typical market returns. Over 10 years, it could reach $150,000 or more. Over 20 years, it could be worth several $100,000. And all of that growth will come from the same 2 funds, the same simple strategy, and the same commitment to doing nothing but holding. The question isn't whether this approach works. The experiment already proved it does. The question is whether you're willing to trust it. Because the hardest part of investing isn't finding the right funds. It's sticking with them when the market drops, when the headlines turn scary, when your balance goes down and your emotions tell you to do something. The ability to do nothing in those moments is what separates successful investors from everyone else. And that ability doesn't come from intelligence or experience. It comes from having a plan you believe in and the discipline to follow it no matter what. This experiment gave me that confidence. It showed me that simplicity works, that volatility is just noise, and that time is the most powerful force in investing. 18 months, 2 funds, and $11,700 in gains. That's the result of trusting the process and letting the market do what it does best. If you're thinking about starting your own experiment, the good news is you don't need $50,000 to begin. You can start with $1,000, $500, or even $100. The strategy works at any level because the principles stay the same. Pick a simple, diversified fund or 2. Invest consistently. Reinvest your dividends, and give it time. The market will go up, it will go down, and it will go up again. What most people don't realize is that this approach quietly flips the power dynamic in your favor. Instead of trying to outsmart Wall Street, you become the house. Every panic sell, every emotional trade, every person jumping in and out based on headlines becomes an advantage for the patient investor who just keeps buying and holding. While others are reacting, you're compounding. While others are guessing, you're owning. That's the hidden edge that never shows up in flashy ads or YouTube thumbnails, but it's the edge that actually builds wealth in the real world. And once you see it in action with your own money, it changes how you think forever. You stop obsessing over perfect entries. You stop chasing hot stocks. You stop feeling like you're behind because you missed the latest trend. You realize that boring, consistent, low-cost investing isn't just acceptable, it's dominant. It wins quietly while everything else makes noise. One of the most surprising parts of this experiment was how quickly my mindset shifted. In the beginning, I cared about every monthly update. I wanted to see green numbers. I wanted confirmation that I made the right choice. But by the end, I barely cared about short-term movements at all. A down month didn't bother me. A flat quarter didn't stress me out, because I had already seen proof that the long-term trend mattered more than anything that happened in a single month. That emotional shift is just as valuable as the financial gains. It turns investing from something that feels risky and stressful into something that feels boring and predictable in the best possible way. And boring is exactly what you want when you're building long-term wealth. If you zoom out even further, the real power of this strategy isn't in 18 months, it's in decades. That same $50,000, left invested for 30 years at an average 8 to 10% return, could turn into $500,000 to over $1,000. Not because of genius stock picks, not because of perfect timing, just because of compounding doing what it has always done. Every year builds on the last. Every dividend buys more shares. Every dip becomes an opportunity instead of a threat. That's how ordinary investors quietly become financially independent. They don't win by being smarter. They win by being more consistent. So if you're watching this and thinking you missed your chance, you didn't. The best time to start was years ago. The second best time is today. Whether the market is up, down, or sideways, the decision to start matters more than the exact day you start. Because 10 years from now, you won't remember what the S&P 500 did this month. You'll remember whether you built the habit of investing or not. That's what actually separates people who build wealth from people who stay stuck. It's not knowledge, it's action followed by patience. This experiment wasn't about proving that these two specific funds are magic. It was about proving that a simple system, executed consistently, beats complexity, stress, and constant decision-making. You don't need to reinvent the wheel. You just need to get on it and let it roll. And if you want, I can turn this into an ongoing series. Real money, real updates, no hype, no fake results, just showing what actually happens when you stick to a simple plan over time. Because the truth is, most people don't fail at investing because they pick the wrong fund. They fail because they quit. They get scared, they get distracted, they change strategies too often. This is what staying looks like, this is what patience looks like, and this is what it can do for you if you let it. Your job is just to stay invested through all of it. And if you want to see more real money experiments, more breakdowns of simple strategies, and more proof that investing doesn't have to be complicated, make sure you're subscribed because there's a lot more coming. This experiment is over, but the journey is just getting started.